You know, we've all seen this massive boom in retail investing lately. With apps like Robinhood literally right in our pockets, buying a stock has never felt more direct or, well, accessible. But beneath the surface of that slick user interface lies an incredibly complex and largely invisible plumbing system. In this explainer, we're pulling back the curtain on that hidden journey and exploring the profound impact it has on your personal portfolio.
Okay, let's dive into this. When you tap buy on your phone, you probably imagine your order zooming straight over to a bustling public stock exchange, right? Like the NYSE or NASDAQ. But actually, for most of us, everyday retail investors, that is not the reality at all. Instead, your trade is intercepted by massive, highly sophisticated entities known as wholesale market makers, long before it ever sees a public, illuminated exchange.
To really wrap your head around the sheer concentration of this system, consider this number: 40%. An estimated 40% of all retail investors' orders in America are handled by literally one single entity, a company called Citadel Securities. If you're buying or selling stock through a popular brokerage app, there is a very, very high probability that Citadel is the one on the exact other side of that trade.
And guys, it actually gets even bigger. Citadel Securities doesn't just dominate the retail space. They process roughly 25 to 30% of all US equity volume across the entire market. That establishes a monumental scale of operations. I mean, we are looking at a system where a single private firm effectively serves as the toll booth for a massive chunk of American finance.
Now, you might be wondering, why on earth do brokers send orders to these market makers instead of just hitting the public exchanges? Well, it all comes down to payment for order flow, or PFOF. See, market makers actually pay your brokerage for the right to execute your trades. This hidden compensation mechanism creates that wonderful illusion of free, zero-commission trades on your app. But in reality, your order is the product being sold. And, you know, being the product isn't always harmless for your portfolio. As documented by the SEC, between 2007 and 2010, Citadel Securities actually deployed proprietary secret algorithms that were specifically designed to give retail customers worse prices on their trades, all while maximizing the firm's own profit. They were actively withholding better market prices from everyday investors just like us. So, for misleading customers about how their trades were priced over those years, the SEC penalized them with a $22.6 million fine. Just think about that for a second. Contrast that incredibly small penalty with their massive scale. We're talking about a firm processing billions in revenue. Mathematically, that fine is less than a rounding error, which really raises some serious questions about whether regulatory penalties truly deter the behavior of market giants. So, okay, that's the retail side of things. But what happens when we look at the big money? Where do institutional investors, like your pension funds or massive 401k asset managers, actually make their trades? Well, you might be surprised to learn that a vast amount of their trading also avoids the transparent public exchanges, opting instead for venues that are just as opaque. They trade in what are known as dark pools. Yeah, it sounds like something out of a sci-fi movie, but these are essentially private forums for trading securities. They're completely inaccessible to you and me, and they're characterized by a total lack of transparency. Now, originally, dark pools were created to protect really large institutional trades from causing massive market panics, but they've morphed into something quite different over the years. Today, these murky waters have become prime hunting grounds for predatory high-frequency trading, or HFT firms. Lawsuits, like a major case involving Barclays, have alleged that dark pool operators were secretly favoring these HFTs, handing them sensitive data and giving them microsecond advantages. This predatory behavior literally allows HFTs to jump ahead of standard institutional orders. And the cost? It ends up costing regular investors and the pension funds they rely on billions of dollars. If we zoom out from these micro-level trades for a moment, from the retail market makers and the dark pools, we really have to ask, what is the massive underlying financial system supporting all of this market leverage and opacity? How exactly are these private entities financing their massive operations completely outside the traditional rules?
Well, this brings us to an absolutely crucial concept, non-bank financial intermediation, or NBFI, though it's much more widely known as shadow banking. Let's demystify this jargon a bit. This sector includes your hedge funds, investment funds, and market makers that perform bank-like activities, stuff like lending and borrowing with incredibly high leverage. But the catch? They operate in the shadows, entirely outside the strict regulatory frameworks and capital requirements that traditional regular banks have to follow. And this brilliantly illustrates the real danger here. Shadow banking isn't just isolated off in a corner somewhere. It is deeply, structurally hardwired right into traditional regulated banks. So when shadow banks take on massive, hidden leverage, they are often borrowing directly from those traditional banks, making this a system-wide threat to our entire financial stability. A recent report by Finance Watch lays out exactly why this hidden plumbing is so fragile, flagging 4 major risks. First, you have extreme leverage, which is often just piling leverage on top of leverage. Second is liquidity risk, meaning cash can dry up in an instant. Third is that profound interconnectedness we just talked about. And fourth, circular exposures. That basically means the massive risks these shadow entities take are ultimately channeled right back to the traditional banking sector, the exact same sector holding your standard deposits. So with such extreme fragility and systemic risk baked into the very structure of modern finance, the obvious question is, why aren't regulators stepping in to illuminate the shadows? How on earth are massive, system-wide risks just allowed to persist and grow completely unchecked? The core issue here is the stark contrast between our idealized vision of the market and the actual reality. We picture these illuminated, highly regulated public exchanges where everything is perfectly visible. But regulators, they're increasingly dealing with a much darker reality, a hidden, deeply interconnected plumbing system dominated by opaque shadow banks, off-exchange market makers, and dark pools where data is fragmented, hidden, or just completely missing. To show you just how dark this data can get, let's look at the Consolidated Audit Trail, or the CAT database. This is literally the very system regulators use to monitor the market. Recently, Citadel Securities failed to report tens of billions of equity and option order events to this database. This massive blind spot occurred under the watch of their data executives, such as Kevin Nutter, the COO of Data, effectively hiding billions of trades from federal oversight. Let's move to and see how this builds, because this wasn't an isolated incident at all. It's part of a chronic pattern of regulatory blind spots. For 5 whole years, from 2015 to 2020, they mismarked millions of short-selling orders due to a coding error. Then, from 2020 to 2024, they failed to report those tens of billions of CAT order events we just mentioned. And the penalty for those 4 years of missing CAT data? A microscopic $1 million fine. And regulatory reform has really stalled out too. For example, the SEC had proposed the order competition rule, which would have ended payment for order flow entirely and forced retail trades into competitive public auctions. However, as reported by campaign finance monitors, following over $100 million in political donations by Citadel's CEO during the 2024 election cycle and the subsequent confirmation of a new SEC chair, that rule was completely withdrawn without replacement. So we're looking at a system dominated by a few massive players, operating in a regulatory void with huge informational advantages. But let's bring this right back to you and me. How exactly do these massive macro concepts, shadow banking, dark pools, regulatory black holes, actually threaten your personal micro portfolio? The absolutely crucial point here is systemic contagion. When highly leveraged shadow banks suddenly face stress, they get hit with massive margin calls. Because they operate with leverage on top of leverage, they are instantly forced into rapid asset fire sales just to raise cash. They start dumping massive amounts of standard stocks into the market, which can rapidly crash the prices of the everyday assets held in your personal retirement account, even if you had absolutely nothing to do with their risky bets. We actually saw these hidden conflicts violently collide in January 2021 with GameStop. Retail investors triggered a short squeeze, and a hedge fund called Melvin Capital was collapsing. Citadel and Point72 injected a multi-billion-dollar bailout to save Melvin. Then, just days later, Robinhood halted retail purchases of GameStop. It perfectly illustrated the completely unresolvable conflict of interest, a market maker processing retail trades for a stock that its own hedge fund arm desperately needed to crash. So, what we're left with is an unbroken machine. A very small number of entities maintain a functional monopoly over retail trades. They operate inside a regulatory void, leveraging massive structural, technological, and data advantages over the everyday investor. They are deeply interconnected with our banking system, yet completely shielded from its strict oversight. which leaves us with one final provocative question to consider the next time you open your brokerage app. In this modern financial plumbing, where your orders are bought, sold, and routed through the shadows long before hitting the light of an exchange, are you truly the customer, or are you just the product? Thank you so much for joining me for this explainer. I hope this helps you navigate the true mechanics of our financial markets.